Hi everyone. So it's February the 7th, 4:48 p.m. Pacific time, 7:48 p.m. Eastern time. I'm gonna do a market update and an SPX challenge update. So right now I'm in the SPX channel. Definitely it's been challenging because we're not at 10,000 yet, but it's slowly moving. Okay, we need to move a little faster, obviously. But what the challenge is, for me at least, doing something like this is very frustrating in some ways and also very refreshing in other ways. In terms of frustration, it's like one of many challenges is just not trading or looking at other tickers, right? There's that time where the market just went nuts, and Tesla, the beloved Tesla, and Nvidia, the tech stocks, were just ripping up higher, and that's unfortunately one of the problems with the SPX. We can easily switch back and forth between the NDX and the SPX. However, the NDX, the volume, the spread is just pretty nasty, and you will require a little bit more than like a dollar, $2 to get into them, right? Because now you're dealing with like a 5-digit underlying, right? Compared to the SPX, which is a 4-digit. So yeah, and then even when the SPX is like relatively flat, those tech names, those tech high flyers, they move, right? And that's a challenge because you might be tempted to jump into a stock like Tesla, and you didn't do any preparation to look at where the moving average, major moving averages, where you can see potential support and resistance, and you might get in it just haphazardly and maybe even make like 30%, which is great. Okay, depending on how much money. I mean, 30% on $100 is not that much, but maybe you put down 10,000. Who knows? Maybe worth it, but in after everything is said and done, right? The SPX, when it doesn't move and it's just slight green, you're going to be looking to sit on your hands while all these other tech flyers like Netflix or Tesla or Nvidia, they're up like 6, 7, 8, 10%, and that's a challenging in terms of sitting on your hands. It's emotionally frustrating, and you just kind of have to deal with it and just understand that there will always be another trade. It's tough. I mean, for me, it's tough. I feel like I want to trade. I can trade. I have definitely enough funds to trade other positions and not even and just trade on my own, right? But I've kind of made it a personal challenge to myself and those who have joined me in this challenge to grow a $400 account to 10,000. This is what it is. This is the challenge that I put myself into. So today and yesterday, there was a specific, after looking at all the data sets or the trades that opened, so there's that right there that you can take a look at. And if you take a look at that's the spreadsheet with the ledger. And we started this on the 10th, and it's been challenging because we're not at 10,000 and we've already exceeded the number of trade limits. Okay. However, we are, performing. I would say that's average, but not even, well, depends on what you define as average, but we haven't blown up the account. So that's like in the last video I mentioned before, we're playing with 0 DTE and things can get pretty nasty. And meaning you can blow up your account very fast if you don't position size. So the position sizing here is on average. Let's see what the average here is. I would say like $1.10. Let's see if I get that right. Yeah, so like even yeah, that's pretty good just eyeballing that number. So $1.10, right? And we've got we start off with a $400 account that gives us approximately 5 to 6 trades depending on how we control that stop loss, right? Because if we can have our stop loss at around 80%, then we're able to salvage about 20. We do that, 3 times, that's $60. That could end. So maybe like five trades, for example. Okay, so the average trade entry is $1.09 and $1.10, and I think so. Like in retrospect, when I look at this, I'm like, okay, this is actually a little. That's okay. I would prefer it to be a little bit less than $1.09, but that's sometimes really tough, right? Because you can't always ask for what you want. So we've been the numbers that I've been seeing have been uh, in the first hour of the day. If you catch like a good move or a wolf wave at the beginning of the day, you're gonna have to get into contracts that are more than $1 to $2. Okay, because other unless you go way out of the money, which is not really like you're gonna be fighting against that DK as prices moving up with extreme bias. You probably don't want to do that, and you want to get into something that's moving almost 1 to 1, and that's probably getting a higher delta, which would require you to require you to be trading those contracts at around $2 to $3. Now, but as you time moves forward toward the last 2 to 3 hours a day, then the premiums start to decay significantly, and then you can kind of see that the contracts that are actually holding any value are around 4 or 5 left, right? At the beginning of the day, it's like 10, 15, 20 contracts. You can go like all the way to delta 0.01 and still, purchase them for like 20 cents. But then as time moves forward and premiums are decaying exponentially, you'll notice that all those deltas are now zero in premium, and you're only left with a handful. And those contracts usually end up becoming around at most like $2 down to like maybe like 7 to 250, 7 to 150, and then as it reaches toward the tapers into the last 30 minutes, then you can kind of you'll see those premiums drop all the way down to like 50, 60 cents. Okay, so in retrospect, yeah, we've been opening up 1 or 2 contracts, and I think if I had to look at all the data set here, and if my memory serves me right, all the winning trades actually happen on the last hour of the day, the last 30 minutes. Okay, so that's important to keep in mind. And after knowing that, you see, like, so after knowing that most of the trades happen, I should actually put in like the actual timestamp of when the entry and exit occurred. And when you think about it, right, like all the mistakes that you can make in a trading day usually happens, it can happen in the 6.5 hours. So if you eliminate 6 hours of the day and actually use the 6 hours for something useful, like your job, or going out and working out, something that's a bit better than just watching these candlesticks move up and down, then you are effectively mobilizing time efficiently, such that when you get back to the desk in the last 30 minutes, then you've got all that blood and dopamine rush that's getting ready for the last end of the day trade, which will be able to allow you to make a better decision and get into position into the last run up. So when I look at the Yuval Deval, okay, let me see if let me pull this up. Let's put this to 200. So the Yuval Deval, like here, these ones, that's the one. Like I'm basically showing you a trade secret, And the way that I look at this is that if I can identify the profile of a UVol DVol, and if you don't know it, just look it up. I'm not teaching the metrics today, but if I am able to show a profile that is ideal, okay, ideal in the sense that it's going to trigger the sell the F and rip level. Okay, there's two levels that I've marked here. That's the first tier and the second tier. And I know with a high degree of certainty that that's going to be able to produce that sharp run up. Then I don't really need to trade any of this all day, because I know that the DK, the way that the DK is programmed in the Black-Scholes model, and the way that the speed, the vega at which the price is moving, is so slow that the DK makes it just really, really tough. And once in a while, you can get into a position where it just really takes off from the very beginning. But then you would have to hold it all the way to the for the full 6.5 hours. Okay, so maybe like this profile here, if you opened up at the morning or even the day before, and then you captured that profile all the way, held it all the way through the day, knowing that this profile would develop, then you can get like a pretty big payout in the last 30 minutes. Okay, and here with the sell the F and rip, obviously the market probably had some profit taking coming in, but there was an event probably that came in on the 1st of February. I don't know what happened there. And then very choppy on the 2nd. And then the 3rd was just the sell off. And then the 6th, which was yesterday, you can see that the profile was mixed. Okay. And then today, the profile was actually looking really good. And we did not trade at the open. That's just, from unless my account is bigger, I'm not taking any risk with the small balance that I have right now. I'm not taking any risk to use the ammunition I have left in a contract that's going to cost 50% of my account, right? I'd rather take that risk where I got 10x, 15x potential in 30 minutes at the end of the day, right? In terms of timing, right? In terms of time, like if we were just reasonable with our time, wouldn't you like to do things faster, get things done in 10 minutes rather than like 60, 1 hour, or who knows? But I'm not saying that the trades at the opening bell are bad. I'm just saying that the cost with respect to my balance that I am at right now is not worth it. It's just not worth it, right? It's better to use the 6 hours of the day for something, just to look at the markets, maybe monitor the profiles of the market breadth, and then see if there's going to be a sharp rally at the end of the day, which happened to develop. Okay, so yeah, you can actually, so today I knew there was a very good chance that we would get that profile developing. Usually it doesn't do this. Okay, that actually really derailed the momentum, and actually it popped up so fast. It was already at like tier 1. Okay, usually that happens at the end of the day, but it got about like 90%, 80% there, and then it pulled back sharply, and I think the puts went up quite a bit had you caught that. So that happened at 1 o'clock p.m. Eastern time, which which was right after a couple 30 minutes, 40 minutes after, probably 30 minutes after the J Powell speech. And then the market just ripped right back up, and then closed right toward close to tier 2. Okay, well, actually it closed right at tier 1, and then after hours it closed to tier 2, which doesn't mean anything. Okay, so and then on Monday you can see that the profile was developing, but it didn't get above the 0 line. Okay, Okay, so if you compare the two profiles from today and yesterday, you can see that it actually got above the zero line at one point, which was the Q, and it got there so fast that it pulled back. Here, it didn't even get above the zero line. You needed to get above the zero line to get toward the first tier, right? That's just kind of like how it works. When it opens up when it closes up in the second tier, that's an extreme level, and then it opens like slightly lower and then kind of pushes, but then the profile is red. You know that there's selling pressure throughout the day, so you're not looking to open up calls when something looks like this. And also, like when you get puts or calls, you're not looking to get into that market when it looks like this. Okay, that's just, it's a setup for a disaster. And you can actually see that we didn't open up a trade. And actually, I've been kind of following some people on Twitter. This lady who's looks very interesting. That's a trade that she traded on the 6th. Russell, the Qs, and the SPY. And you can see there's no way that you can clearly tell, well, here in terms of whatever she's using to make money, whatever like signal or strategy she's using to make money, it didn't work. And it wouldn't have worked because you can tell that the calls on the volume, like no one was really buying into them. Okay, it's just clearly from here you can see that it just, and we didn't take any trade. Okay, so even I think the market was choppy on Monday as well, right? It gapped down, so there was really no reason for us to get into a trade on that Monday. So I had a person ask me about the way I exited the position that we opened up today. That was this one right here. So I opened up one contract, and I could have opened up two, but I still, until I reach like over 1,500, I'm not opening up more than one anymore. But yeah, here today I opened up the 4,170 contracts. I actually wanted to get into the 4,160, but it moved too fast. And that's another thing. Like these contracts move so fast that I get kind of like, I get into the position and they're already up like $1, like 20, and then they drop down to like back to 90 cents. So they move fast. I think I need to figure out how to make the alerts give everybody a little bit more heads up when I get into it. But it is what it is, right? So yeah, then and then I said we want to close these positions 1 minute before the closing, right? So and then I closed it off at $6.20. I think it moved up as high as $6.80 to $7. So then people are asking me, well, how did I know that it to close at 620? Well, I knew first of all because it went from 90 cents to $4 pretty damn fast, and then it paused. It actually flagged on the 1 minute. Let me see if I can pull up the chart. The 1 minute here. So I think it was right here. Yeah, we're talking about this one here. All right, so I think I alerted it right around here. Okay, that's 3:45 p.m. Eastern time. Yeah, so that's like 3:46, right? So I alerted it right here, and then it actually, that small little wick right there was a second entry to get into 90 cents right there. Okay, so I got in around this wick, and then the second wick that opened up the next 1 minute candle, it pulled back and provided another entry at 92 cents. And then it ripped up even higher and flagged here. So then As I was watching this, the market closes right around here. Okay, market closes right here. Okay, let me make a line. Okay, so that's the line. That's the closing bell, and it flagged here. So that's a bull flag. When it creates a pull and pulls back, you shouldn't close it, right? Especially knowing that the UVol DVol profile is super bullish, and we're looking for a run up to the sell the F and rip tier one. So then, as it held that moving average, right, because the trend is still your friend, it proceeded to move higher and break out. Okay, so that's the breakout from 4,178, and then it moved up. And as soon as it starts to run up, okay, as soon as it makes this large big candle, you've got to close positions. Okay, you've got, and since I only have one, that's all the close. I can't divide that by two, so um, I've got to close that position off. Now, I already knew that there is no way that this is going to go to tier two. So even if I had one or two contracts, I would not have held on to the second. I would have closed both contracts. And then typically on Tuesdays, the end of the day, the last minute or two, there's a sell-off. So that's why I said you want to close it before 1 minute. So that would have been, you would have been closed it on that candle, which went pretty much to zero. So then when you look in terms of time and reward, I entered the position here, and after 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, after 9 minutes, I made about 500%, right? So I mean that's pretty good, and that's what, and I knew that tier two was not going to trigger. So knowing that, and then knowing also the momentum has accelerated exponentially, it was a good sign for me to like take those profits and just run. Okay, and yeah, at the end of the day, you have that the saying that I usually say 10 seconds into close, and that's usually what happens. At 10 seconds into close, you can get that sell off, and then you can enter into those positions, long positions at the end of the day for cheaper, right? Because here is at 4,188, and then now it's like $7 cheaper. So that's the reasoning. And then another way to reason it is that once you see a squeeze and you're like 1, 2, 3, 4, 5, 6, 7, 8, 3 to 8 cycles is usually the most that you want to be. Actually, the most is 14, but that's 8, 9, 10, 11, 12, 13, 14. 14 wouldn't cut it, right? So you got, there's a bit of a judgment call here, and also like the average when we make a big move, and when our positions make a big move and we make like 5 to 10x, haven't caught a 10x yet, but when we do make those moves, 10x usually requires you to hold it a little longer. But 5x, when you have like just literally 4 minutes left, I think it's, and especially when we're still underperforming in the campaign, all the signs were just showing that it's better just to take the profits on that initial run up after that bull flag, and then wait for the next profile to develop. Okay, so in general, the 10K challenge is something that I am very committed into achieving that 10K using such a small balance. And what I'm planning to do is I'm going to make this so routine, because I actually can see a profile that makes every single $100 trade worth risking at the end of the day. And it makes perfect sense to me that trading in this manner is more efficient, more beneficial for you, and also pays out way bigger than you can imagine when you trade. Like when you compare that with the tech stocks. Now, tech stocks can have their moments, right? And for my plan here is when I start trading back into tech, first of all, it'll be either after I reach 10,000, right? Because then I will have a milestone in something that I can say, okay, I've made I've worked really hard to grow a $400 account to 10,000 using very small risk. And now I want to diversify my trading appetite into something into like the tech, right? Where the beta is pretty high, and I want to try to catch these big moves that can also pay out 10x, 20x, potentially maybe using like a strategy like TGIF or a double Bollinger Band strategy, whatever strategy you want uh, that you want to use. That's basically that. Or another reason that would get me into trading back into like Tesla or Google or Nvidia is when they get back above 500. Okay, trading options when they're like at $50 or $100 or like 200, it's a little bit, the it has to make a bigger move, right? For a $200 stock to make a 1%, for a $200 stock to make like a 10x move, it has to move like 15% like one day. Whereas the SPX 0DT, it only needs to make a 0.5% move, right? So it's night and day in terms of the risk and reward. And that's basically how I look at it. The risk and reward is much more attractive and safer, right, in the SPX, especially when that setup that I talked about when using the UVol DVol is present. When it's not present, okay, and then maybe we get a profile that's very bearish, because it does look like the market could take a breather and pull back to the 21-day moving average. Then we'll be using tools like the Wolf Wave to support a bearish trade that will produce a 10x, 20x profit in the SPX. But until now, I'm just looking at a very simple setup using the UVol DVol with Wolf Waves, okay, and I'm looking to finish the challenge hopefully by the end of this week. Let's see if that happens. If it doesn't, let's say if we get my challenge up to, let's say we're up like, I don't know, so we're at 800 and maybe I'm up like 6,000. Okay, and then it takes us maybe up to like 25 to 27 trades. I'll end it there and then create a new campaign, because I don't want to keep this ledger I want to actually make this a little bit change this ledger into something that has columns a little bit more useful. Like I'm going to add a timestamp and then probably have like a screenshot to the type of images that shows the UVol DVol, so it kind of makes it clear in the reasoning why we got into the trade. All right, so yeah, that's it for for my update. And finally, let's take a look at the market. So S&P futures, okay, on the daily. Right, so we know there's a gap here at 4,225. I don't know if it's going to fill tomorrow, Wednesday. I mean, we have got, I think, the president that's speaking tonight that could rally the market 2%. I mean, if you look historically at all the times that the president has addressed the union, it's been mixed. Okay, so I mean, but look at the trend. The trend is still your friend, but as the trend continues to move higher, the probability of a pullback to the 21-day moving average, which is still bullish, increases. Okay, so doesn't look like it looked like we're gonna spill over here with Jay Powell, and that didn't happen. If you read my morning update notes, it said that I expected the market to move higher, and then the Fed would probably create a little bit of uncertainty and pull the market back, and then we get the rally. It was actually the anticipation of the move was almost perfect. The only perfect thing was that we didn't execute the Jay Powell event. So yeah, the trend is still intact. It looks like 4,200 25, that gap is still there. You can see it. It's about, how many percent away is that? Yeah, 1.4% is not a very big move, right? Today the market moved up 1.4%, so it's not. It can happen tomorrow or Thursday, and if it does, right? If we get like a pretty big move tomorrow, I think we get the same type of profile in the UVol deval that will get me into another trade in the last 1 hour to 30 minutes into the closing bell. Okay, that's what I'm looking for, and that would, if that happens, then this candle right here would be a very big long green candle like that all the way up to here, which is a pretty big candle. Let's see if we can superimpose that candle right here. I mean, it can make big candles, right? Like, look at that wick. Let's just take that, not that much, but let's just take the body and move that candle right there. Yeah, I mean, it's possible, right? It's anything's possible. The probability will depend on what Biden says. Now, if Biden says something different, it would just be a doji. It looks like, and that would be a flat Wednesday, setting up for a BLT into Thursday. Now, now if we get a BLT on Thursday, meaning that Wednesday is a flat day, and Thursday is the one that really rips the market higher, which is, let's take a look at the economic calendar. How come this economic calendar is always garbage to me? You know, I don't know if anyone else has get this same problem, but I don't know. Let's look at February. Why do I do not care about these other countries? Clear. Nope. Clear. America. United States. All right. So Wednesday, we know we've got, okay, got a Fed. So I don't know what's going to happen. And then Thursday, we got initial jobless claims. Okay, so the previous the previous data set modeling the initial jobless claim came in lower, and I think the market actually moved higher on that. So I wouldn't be surprised to see a repeat of that, and then you got a Fed speaking on, well, after the market, well, at 12:30 on Friday. That could set the market up for a red Monday, like we saw last Monday. So I think, if I had to take a guess, the State of Union address will probably be a non-event, maybe resistance here at 4,187 while the futures are open, and then end up becoming flat for the day. Then we rip higher on Thursday on economic data, filling that 4,225 yet finally, and then we roll over and then drop all the way down to the 21-day moving average, which would probably be at 4,076 by that time. Okay, I hope this helps. Have a great day.